Are you a Canadian looking to save money on your annual tax bill? In this video, I break down some of the most frequently asked questions when it comes down to tax planning for Canadians. My name is Quinton. I'm a wealth advisor, certified financial planner, and chartered investment manager. And over the last decade, I've been helping Canadian families and business owners save money on their annual tax bill, grow their wealth, and live with more financial clarity and peace of mind. When it comes down to financial planning in general, taxes are always an important consideration. When you have a proper plan, you can make tax-smart decisions and better ensure you're proactively reducing your tax bill both now and in the future. So here's some information on some of the most frequently asked questions when it comes down to tax planning. What strategies can I use to minimize my annual tax bill? The best way to reduce your annual tax bill is to have a plan. Understand what combinations of strategic moves works best for your specific situation. So here's a few common strategies. Make contributions to your registered accounts. By making contributions to your accounts like your Registered Retirement Savings Plan or your RRSP, contributions are tax deductible, reducing your taxable income, and they grow tax deferred until you withdraw it. On the other hand, you have your tax-free savings account. Although the contributions are not tax deductible, the money grows tax-free, and then when you withdraw it, it is also not taxable. Then there's making charitable donations. Donations to registered charities can give you tax credits, which reduce your tax owing. You donate cash, or you can consider donating appreciated securities instead of cash directly to the charity to avoid capital gains tax on that appreciation. And then there's income splitting. If applicable, you can shift income to a lower income spouse through spousal RSPs, or if you have a family member working through your business, you can pay them a reasonable salary. Alternatively, if you are the higher income spouse, you can cover more of your household expenses, which allow the lower income spouse to save more money. Then there's utilizing capital losses. If you have investments that have lost value, strategically selling them to realize a capital loss can offset any capital gains and reduce your taxable income. Capital losses can be carried back up to 3 years or be carried forward indefinitely. Then there's deferring income. Now this isn't always possible, but deferring income to the next year, specifically a dividend or a bonus, can be beneficial, especially if you project yourself to be at a lower tax bracket. How can I make the most of tax deductions and tax credits? Understanding and maximizing available tax deductions and tax credits can significantly lower your tax liability. So here's how. First is make sure you're tracking all eligible deductions, making sure you're claiming all allowable deductions for your specific situations like RRSP contributions, childcare expenses, or interest on investment loans. Then there's claiming home office deductions. If you work from home, you may be eligible to deduct home office expenses, including a portion of your rent, mortgage interest, utilities, and other maintenance costs. Then there's leveraging tax credits. Unlike deductions, which reduce your overall taxable income, credits reduce your overall tax bill. You may be able to claim common credits such as a Canada Caregiver Credit, tuition and education credits, or the first-time homebuyer's tax credit. Then there's using your spouse's unused credits. If you have a spouse or common law partner and they're not using all of their personal credits, you may be able to transfer them to your respective tax return. What are the benefits of tax-efficient investing and how can I implement it? Tax-efficient investing aims to reduce the taxes you pay on your investment income. This enhances your overall after-tax returns. Here's why it's beneficial and how you can implement it. First, it's understanding the different types of investment income. Different types of investment income are taxed differently. For example, dividends from Canadian companies are eligible for a dividend tax credit, whereas capital gains are taxed at 50% of your marginal rate. And then we have interest income, which is taxed at your full marginal rate. Then there's considering the benefit of asset location. An example of this is using your TFSA or your tax-free savings account for high growth investment because the earnings, including capital gains and dividends, are tax-free. Another example would be using your RRSP for investments that generate high annual income, such as bonds, because the income is tax deferred until you withdraw it. This is especially beneficial in retirement when you may be in a lower tax bracket. After you fully maximize your registered accounts, such as your RRSP or your tax-free savings account, you can really only invest in one other type of account called a taxable account or a cash account or a non-registered account. It's all synonymous. And in this account, you want to hold investments that have preferential tax treatment, such as capital gains or dividends. And last, we have investing in tax-efficient funds. For taxable accounts, consider mutual funds or ETFs that use strategies that minimize taxable distributions. These funds are structured to reduce their turnover and therefore capital gains distributions. How do my retirement accounts impact my tax obligations? Retirement accounts like your RRSP or your RIF, your Registered Retirement Income Fund, and your tax-free savings account can have significant implications both while you're saving and withdrawing. Let's start with RSP contributions and withdrawals. Contributions to your RRSP are tax deductible, which helps reduce your current taxable income, therefore you're paying less taxes. However, withdrawals from your RRSP or your RIF are fully taxable as income, and planning when and how to withdraw from your RRSP can help minimize taxes. Strategies like taking smaller withdrawals early or laddering income over several years can help reduce your overall tax hit. Then your TFSA benefits. Contributions to your TFSA are not tax deductible, but withdrawals are completely tax-free. And they also don't affect income-tested benefits like your old age security or your guaranteed income supplement. Then there's pension income splitting. If you're 65 or older, you can split up to 50% of your eligible pension income from your registered accounts with your spouse or common law partner to lower your overall tax burden. Now, you don't actually have to slide the money across the table to your spouse. This is simply a box that you need to tick on your annual tax filing. Then you want to make sure that you're using a withdrawal strategy, and it's coordinating your withdrawals from your different accounts such as your RRSP, TFSA, and taxable account to manage your taxable income each year. The goal is to maximize tax efficiency while ensuring your withdrawals are aligned to meet your income needs. So here are my final thoughts. While these tips and strategies can be very useful, everyone's tax situation is unique. Therefore, it's important to speak with your tax advisor for further discussion and analysis before implementing any tax planning strategies. Whether it's minimizing your annual tax bill, leveraging deductions and credits, or managing the tax implications of your retirement savings, having a proactive approach can make a significant difference. If you're looking for a clear process to make sure you're making the most of your tax picture, download my tax savers checklist in the link below. Again, don't forget to like, comment, and subscribe so you don't miss future videos just like this. Until the next one, take care.